I love index funds. I think investing in index funds is the most efficient and most effective way to build wealth. I talk a lot about the S&P 500 index fund. And the reason is it's one of the oldest indexes in the United States. It happens to track the 500 biggest stocks in the United States, and it's in the country with the strongest economy in the world. So it's an obvious index to point to when you talk about measuring the strength of an economy. But when I talk about investing, I also love investing in a target date index fund. So people often ask, should I invest in the S&P 500 index fund or in a target date index fund? And the answer is you should really understand what you're investing in and why. And so let's break it down. The S&P 500 index fund is the list of the 500 biggest companies in the United States, and investing in that fund would be buying into the full US economy. A target date index fund is a little bit more complicated, but not too much, so let's get into it. It's basically a fund of funds. Inside of a target date index fund is three main components. First is a US index fund, so very similar to the S&P 500, but instead of the top 500 stocks, it's actually almost all of the stocks in the US economy. The second is an international index fund, which includes thousands of international non-US stocks. And the third is a bond index fund, which includes thousands of bonds. A target date index fund also has some other advantages. It rebalances those three funds automatically, and it reallocates those funds so that as you approach the date of the target date index fund, it's moving more away from stocks and towards bonds. Each target date index fund is named after a year. So for example, this one is a 2050 target date index fund. And as you grow closer to that date, it's going to move more away from those volatile but faster growing stocks and more towards the safer income producing bonds. So when you ask the question of which one should you invest in, they're both great options. The S&P 500 index fund is a great way to invest in the full US economy. A targeted index fund is actually made up about half of the S&P 500 index fund. And so all those stocks are already inside of a targeted index fund, plus you get the smaller stocks in the US, plus you get international stocks, large and small, plus you get bonds, plus the benefits of rebalancing those different funds and reallocating them towards the safer bonds over time. Some people might just want to bet on the US economy, or they might want to make their own portfolio with their US stock and international stock index funds. I like the all-in-one option. Set it and forget it. Put all your money in there. It doesn't give you any rope to hang yourself with. But hopefully this helps you understand the differences and why you might choose each.